All right, ladies and gentlemen, hello. My name is Darius Anucauskas, and I'm the Chief Market Analyst here at Markets.com. And today is Wednesday, ladies and gentlemen, the 3rd of September, 2025. Look, I wanted to quickly do this little piece on everything what's happening right now and with bonds, and everybody's crazy about that right now because the market is kind of getting into this fear mode. Look, before we jump into any action, let's have a quick read through our risk disclaimer. So yes, the content we produce does not constitute investment advice or investment recommendation and should not be considered as such. This material should not be taken as an invitation to acquire any financial instrument or product. I'll give you a few seconds to read the rest. I'm not going to disappear anywhere. But yeah, if you haven't noticed, the news are now talking about, apart from the geopolitics and about all the meetings in China and how US is not happy with that and all that stuff. Basically, we have another little issue that it started occurring, or I should say, everybody started kind of mainly talking about that issue yesterday when the U.S. came back into action because they were closed on Monday. It's the bond deals, and look, let me just quickly mention our Markets.com website, which you can always check out for more information about us. If you have any questions, reach out to us. We'll be more than happy to assist. But certainly, straight away, let's jump into the charts. GBP USD will be the other one that I will be talking about. But for now, I just want to quickly let's pick up on actually on the UK 30-year gilt here. And look, okay, this is a daily chart, but what we're seeing right now, we're seeing a little bit of a retracement. But today, this morning, we were rallying heavily. And look, we managed to make our way towards the area around here. This is the 5.75% here on the 30-year gilt. I mean, look, yes, I would say, what's the big deal in a way, right? I mean, what we have been at near these highs have already, and this is like, yeah, I mean, nothing major, just a little bit of an up move here. But if you look at a bigger picture, if we jump into a monthly chart, you'll see that we are getting closer to levels like 6%. Or in general, right now we're at levels which were last time seen back in 1998, and this is a little bit worrying. And another thing, look at this. Just kind of being at the lows here, or somewhat of a lows, in at the end of 2021, and from there we kind of really rapidly shot up here in a matter of a few years. Of course, rapidly. If we're measuring this rapidness and if we're comparing it to this kind of trajectory here, then yes, of course, there was a gradual decline for some years. Look at this. I mean, from like 1998, since around like 2011, we were kind of flat. Then we started declining heavily, and then it seems like we found good floor right here somewhere. And yes, since then we kind of started pushing heavily to the upside, and now we're approaching these levels around 6%, and or of course we're below it right now, but we're going there. And this is what the market is kind of afraid. And look, if when the yields start rising, then of course it becomes a little bit more expensive for countries to borrow. And certainly it does increase demand of bonds, because again, why do you need to stick around in the stock market when you can actually just jump into bonds, right? And with such a yield, well, it's a relatively decent yield, so it's doable, right? For now, I would say this way, that of course UK is one of the big ones here, and everybody's talking how massively it has jumped right now. You can look. I'll say it this way. Let's compare. So UK from the beginning of this year, kind of their bond yields rose around like 11%, or actually even if we take it to today, right now where we're now at 10%. Now, if we take a look at the US, for example. Let's have a look at the US 30-year government bond. So the US has risen only around like 4%, now even like less than 4% at the time of this video. So yes, there is an issue, but look, in July we were higher than that, and in May, we were even higher than that. So in a way, the markets, I think, more, worried not about the U.S. They're more worried about other, like European ones, and in particular, also, the UK, the France. Let's say actually, let's see if French, government year bonds. There we go. This one. That's what I'm looking at. So this is the one. So this is the French 30-year government bond yield. And let's have a look at, from where did we start the year? We started off somewhere around here. Let me just put this one. Yep, there we go. Around here, and now we're kind of gaining. It gained around 20% already for this year. So this is kind of an issue. When we have this rapid rise, then it becomes, the fear factor starts to kick in. Because again, this is the yield, the bond yield curve is somewhat of a measure of the fear in the stock market. Whenever the yields start rising, then the markets start becoming more fearful, because again, this kind of indicates that inflation could be on the rise. But then you're also thinking about interest rates, and that the banks will have to kind of start increasing rates. And the reason why they're increasing rates is because inflation is picking up. So in a way, you have this the bond market is kind of an indicator of sentiment, of what investors do feel. But I think that the creme de la creme in all the madness right now is the Japanese 30-year. Let me just put down the 30-year. There we go. And that one is on fire. Look at it. From the beginning of this year, this is what I was measuring today, this morning in my webinar. 44% from the beginning of this year. I mean, Japan is a little bit in a pickle, I would say. Certainly, we know that the central bank of Japan, the BOJ, is planning to go for a rate hike. Not during the upcoming session, which is going to happen on the 19th of September, but they're planning to do a rate hike in October, at the end of October. And of course, this is also fueling into all this. I mean, this is not really helping here. Certainly, it is trying to attract attention. Maybe this way you can attract more more people who want to invest into your government bonds. However, are they actually going to do that at the moment, when they know that maybe I'll wait a little bit more and then I'll get something higher, because again, interest rates are going to go up. So again, there's a lot of issues here, and the bond market is, of course, at the center right now. Again, maybe we have a lack of other news. Again, don't get me wrong, but of course, I'm joking. Of course, no. The bond market is important, and we need to keep a close eye on that yield curve and those yields, especially looking at the 30-year. Look. Also, the fact that if interest rates are going to start going up, I mean, this is impacting the mortgages. It could impact the mortgages and housing market. So there's a huge things that come out of this, and that's where we find a little bit of fear. Now, how this is looking at how this looks in the forex world. Well, we saw that the British pound did lose ground yesterday against the US dollar, because US dollar yesterday strengthened. Let me just show you what I'm talking about here. US dollar yesterday strengthened, mainly due to the fact that it's kind of a safe haven currency, and that's where like if we're seeing an increase in yields, then there is demand for the local currency as well. And this is where, and also given that the US dollar seems to be somewhat of a safe haven, everybody started jumping into that one, unlike the British pound or the euro. The euro, we saw also retracing back down, but everything still is fine. So with the euro USD, you can see that from the technical perspective, we're still holding above the 50-day EMA, and there is still positivity. However, personally, for me, the positivity could come on a break of this downside line. But given that we're very close to the 50-day EMA, there is a chance of a break here lower. So again, we're monitoring this situation. We're monitoring the situation with the yields on all these bonds here. We're seeing currently a little bit of a retracement. in the 30-year bond yields in the EU one as well, and maybe this, this is helping maybe to stabilize a little bit the euro, and maybe the fear is kind of kind of pushing away. However, we need, I think, a little bit more time, and we should not be abandoning any any kind of bearish case scenario. So for now, while looking at this Euro USD situation, I'm kind of leaning a little bit more towards the downside here. However, because I don't think that this bond yield issue is kind of going to go away very quickly, unless it's going to get overshadowed by maybe tariffs, or because again we know that the tariff situation right now is in question because the court is kind of ruling that it could be illegal, that tariff, the U.S. has imposed tariffs on other countries. So again, it's a lot of different interpretation, and we're waiting for kind of some sort of an outcome from that. And I think that could overshadow the whole bond yield issue, because maybe that could be seen as a positive. The court ruling, if it comes out saying that, oh, it was illegal to impose those tariffs, then yes, everybody forgets about bonds, and and everybody starts cheering hooray that trade is back to normal again. But then there's another aspect of it, like because of the tariffs and how much funds they could have raised, it's not going to go into the U.S. economy, which needs that money to kind of reduce the trade deficit, to reduce the debt that the U.S. holds. Again, there's a lot of like ifs. We can speculate too much, a lot, but I think that we need to kind of wait a little bit first of all for the court ruling, and of course we continue to monitor the situation in the bond market, in the yields, what's happening there. GBP USD, which I picked up recently, like I said, you look at this one, it's near a key area of support, near the 100-day EMA, so near that 1.3370. A nice good drop below that could open the door towards the 200-day EMA, and then we could go from there. But but at the moment, what's happening in the stock market, you can see that U.S. top indices have kind of slowed down the slide that we saw yesterday. So maybe it was just like a little one-off. Europe was also stopped sliding, found good support near the 100-day EMA here on the DAX, but coming back to the U.S., look, maybe this whole bond thing could have been like a little hiccup. However, I think it's going to stay here, but certainly there are these little pieces of information that are coming in which can kind of lift the stock market back up and kind of ignore the whole bond yield uprise, kind of push the problem a little bit further away, right? Because again, we're getting Google is getting good news, that they're the court also ruled in favor of Google in that lawsuit where it was this antitrust of Google for the Google Chrome part, and also of course job numbers. So I'm recording this on Wednesday, and basically today in a few moments we're going to be getting the JOLTS, and the JOLTS right now are expected to come out a little bit on the lower side, and the same story with ADP on Thursday, tomorrow. It's also expected to come out on the lower side. Where's that number? There we go. Much lower number against the previous 104, 68K. The NFP is somewhere in the same level. I mean, but again, it's going to be interesting to see what's the actual number going to be. At the moment, this is the expectation. This one. There we go. 73 previous, 75. But again, as I said this morning as well, the 73 for me is going to be the more interesting number. And I mean, how much it will get revised. So anyway, ladies and gentlemen, I hope this helps. I just want to drop a little piece of info here on the bonds, and kind of the final idea in a way is to, yes, it matters. Yes, we need to keep an eye on it, but don't forget about other little pieces of information, potential positive information that could be coming in and pushing the bond yield issue a little bit further. Yeah, but so for now, yes, it's an issue. However, it can get overshadowed by other events, at least for now. So, ladies and gentlemen, as always, stay safe, have your stop losses in place, risk only what you can afford to lose, don't overtrade, and everything will be fine. And I'll see you in my next little video update. Bye for now.